The best strategy and the most tried and true strategy in real estate is buy and hold, and you can absolutely build your own cash flowing business doing that. Welcome to another episode of Multifamily Strategy. I'm Christian, joined today by Caleb, who's co-hosting with me. Guys, we're in Dallas. Welcome to the new studio. There is a little bit of work in progress going on, so I'll be making adjustments. You'll see the shelves starting to fill up. I may go with less bright lights in the back. We haven't decided everything about everything yet, but coming to you today with a bunch of updates. I really want to share the business that we've built and how it's worked. I keep seeing posts online, Caleb, where people are talking about, hey, cash flow isn't real. You can't obtain this. And quite honestly, we have. And it sounds like it's harder to do than some people think. So I want to talk about how we're building our business, how we're actually buying deals that do actually cash flow, and how we're protecting that cash flow. Because I've seen this on Bigger Pockets, I've seen this on Instagram, I've seen this on YouTube. People are starting this rumor that you can't actually build a cash flowing portfolio, which is crazy because I don't know how you do buy and hold if you're losing money every month.
Yeah, it doesn't really make sense. What's the point of holding it if you're losing cash?
Exactly right. So in today's episode, we're going to talk about how we're building our business so you can basically just copy exactly what it is that we're doing. So hope you enjoy this special episode. Also, get used to seeing more of Caleb and Danny on this channel because they're going to be joining me from the actual studio. I run from the wide lens until I get my other cameras working because right now they decided hard pass.
Turns out when you live in Dallas, you get to be on the channel more. So thanks for having me. I appreciate it.
Absolutely. Also, a quick announcement. We're going to be running our first ever meetup later this month. I haven't
Be
planned
there.
the exact date, but yeah, be there. It's going to be in Dallas. We're looking at a location. What's your friend's brewery called?
The Manhattan Project Beer Company. It's basically at their brewery, downtown Dallas, kind of in the Trinity area.
Perfect. Very, very, very excited for that. Happy to have a location. Happy to be in Dallas. Happy to have finally landed where we're trying to land. Again, still working on finalizing all of our equipment. So if our mics are falling over, we apologize. All right, so cash flow. I really wanted to share this. First of all, there's 3 ways to increase cash flow. No one's talking about this online for some reason. You borrow less money, so that means you put more down, which means you have to actually save. Like if you earn enough money, or you can raise money elsewhere, but that usually comes at a cost. If you borrow less money, which means you have more money, you can increase your cash flow. I think that's what a lot of people are talking about, though. And they're like, oh, well, you can't start with multifamily. You can't start with investing.
And I get what they're talking about, right?
Yeah.
If you're buying the deals most people are buying, these gurus, you're not going to be able to start there. You're going to need to have a base. You're going to need to have active income. And that's we're looking at something outside of the box that most people aren't doing. That's where the cash flow comes from. So if you're trying to buy 5 cap, 6 cap deals right now on 7% debt, that cash flow is probably going to get wiped out, especially if you're buying heavier rental projects, which a lot of people do.
Yeah.
Turns out you need a factor for that renovation. Crazy.
Yeah, crazy, right? So you have to factor in the renovation. That's a given. But as you're starting to do this, there's another way to fix it, which is borrow cheaper debt. Now, if you're buying that same 6 cap deal, but you're doing 4% interest only on a 10-year note, that's going to cash flow.
Turns out that works a lot better than 7% amortized over 25 years.
Every dollar borrowed will have a 2% spread. 4% interest only. You can compare interest only to the cap rate directly, by the way. Your spread is the difference between the two. If you're looking for loan factor rate and you have an amortized thing, you just add principal plus interest. That's your monthly payment divided by your debt. And then you can compare that number to the cap rate. What you're looking for is a cap rate, which is your return on investment, higher than the cost of debt. Now, right now, it's harder to make deals cash flow.
For sure.
For that reason, because debt went up double from what it was,
But at that
really rapidly.
At that same point, people are out here, oh, you can't buy deals right now. I'm sidelining money, yada, yada, yada. That's BS. There are great deals out there. We're actually under contract on the best deal either of us have ever done. And this is happening in a market where people are saying, keep your money on the sidelines till the election. We're going to close on this thing before it's over.
Yeah.
Why are you holding off and scared that there aren't good deals out there?
And traditionally, when the market's scared, this is the best time to buy. So like right now, when we're in a transitionary period, this is statistically the best time you could be buying. But regardless, that's a way to make a cash flow. Now, there's another thing that really kills these, and I think I've heard every single video I've seen. The Bigger Pockets folks, the people from just on my Instagram channel. I won't name drop everyone, but I've seen this from a ton of people. Oh, well, your deal eats all the cash flow. Like all the cash flow always goes back to the deal. I've been there. Caleb's
been there more than I wish. And how you solve this, you just raise more money or buy a better deal with less heavy renovation.
Now, if you raise more money, though, that has a cost, right?
Yes, but just buy a better deal where it's supported.
There we go. You have to do your intro math. You just go, okay, if I'm buying this deal for, I'm just going to use a imaginary number. Let's say we're buying a deal for $800,000. I'm going to do my math with an extra, let's say, 10% budget. So I really need 880. If I'm going to put 10% down, it's 80,000 down. Well, I need to raise 160, not 80. And that is a mistake that almost all investors make, as they figure out, what do I need to close? I did that on my 38, on my first 7-plex.
I did that on my first 2, 3. I raised some extra money. Still should have raised more. Wasn't even deal 4 we should have raised more. And it's not till now where we're looking at projects and we're like, I would rather borrow more money to make sure I'm not having to come out of pocket later of that cash flow and then be like, oh, deals don't cash flow. I'm a guru. Like, whatever.
At the end of the day, I want properties that pay me, and I want them to pay me every single month. Now, if I have a reserve, say I have that $80,000 reserve if something comes up and we have a $30,000 expense. Well, that reserve goes down to 50. One, we've covered the expense, so we might not need to up it back to 60. If we're up to 80, we may not need to actually refill it. Maybe we find that 50 is enough after some time operating.
And it really depends on the deal, right? Like, if we're talking about the deal we bought, the Trinity.
Yeah.
We had 2, I guess not major capital expenditures, but 2 heavier ones. But the turns on that building are so freaking easy and cheap. We had a crazy case of black mold, which was ridiculous. You don't want to breathe in that stuff. And then we had another case of an absolute hoarder who wasn't reporting bed bugs. And those weren't cheap, but everything else has been so cheap on the turns, or pretty much paint and cabinets, really.
But what ended up happening is we have the reserve for it. So the cash flow continues to roll in. We go out of the reserve count. The reserve actually fixes up the building, so now we have less deferred maintenance.
Exactly.
And what you do is, as the income of the building goes up, we continue to pay ourselves the same cash flow. We just allocate all the, like, we get new rents. We're bringing rents from like $450. We're placing new leases at $900.
It's ridiculous.
Taking the excess cash flow and refilling that reserve account. What you really want to have is, once you're used to your operations and you know what your costs are, you want to really have 3 months of operating cost in reserve. Once you have that, you can just pay yourself more. But if you keep buying deals that cash flow day one, and you structure them this way, where it's like, okay, I can put more down, but if I don't have the money, that's out. So what a lot of people are talking about online is legitimate. If you're broke, you can't do option 1. Number 2, you borrow cheaper debt, which you can do with creative finance, which we have done on so many deals. Also, you can find deals that cash flow 8 or 9%. A 9 cap will cash flow on 7% interest.
Don't talk about the deal the new deal we're looking at, Steven, one of them.
Ooh, okay, this is a good example. Anyone could do this deal.
Like, this thing was on market. Literally, I'm a stingier negotiator than most. I don't like giving an inch.
Yep.
Didn't give an inch on this one till the last second, and I was like, it's a deal I'm not going to pass up. So I gave a little bit. Got the deal, $200,000 below what they listed it for. You go through their operating expenses, there is so much fat to cut. These are out-of-state owners who want to be completely passive. Turns out we have a management company in the area. So we're going in. Day one, our costs are going to be much lower. We're buying a deal that's over a 7 cap day one on 6% debt. And how are we getting that 6% debt?
That's going to be conventional debt. We're actually going direct to Fannie Freddie on this.
Not what most people do.
Yes, because this is a low-income property, there are actually debt products that are going to be preferable for us. Again, the usual, we're talking long-term cash-flowing fixed-rate debt, but it is a long-term debt product. We're going to come out right around 6% interest only. Because it's less than a $7 million loan, interest rate goes up a little bit because it's not a large affordable loan. But interest rate comes down because it is an affordable loan product, and there actually are benefits doing that. In addition, we're going to get 50% off our tax bill, because we're doing affordable housing in the state of Texas. And if you're anywhere but Tarrant County and Dallas County.
And then Harris County, Houston, Texas. Well, Dallas, right, Worth, and Houston.
If you're not in like the main DFW or Houston, you can get these 50% off tax things for doing 60% subsidized housing. And it's actually super easy to apply for. They do monitor, but it's actually fairly loosely monitored too.
Fairly loose, very monitored. But getting into that and learning the intricacies, it took us maybe 3.5, 4 months to really figure out how we had to structure this thing, though?
Yeah, it took some time. But now that we're there, this is a deal where I'm not saying like anyone off the streets is going to be like, oh, well, I'm going to spend 3 months figuring out how to do this. But there are deals like this. This is we're talking about the 44 unit.
44 in Stephenville.
What's the price on that?
$185.
$185.
Built in 2005.
To be clear, we're making a ton of money on a 25-unit building that we purchased for $2 million in the same town. This is 44 units for $1,850,000.
30,
best deal
30 years newer.
So here's what I think people are saying online. If your thought is, hey, I'm going to get two fourplexes and I'm going to retire on that, never going to happen. Never going to happen.
I think the big issue is this myth that going around for a while. I don't know if it was the mainstream real estate media stuff, whatever. Like these gurus saying, oh, you buy these deals and you go retire. That's not the case. I think when I got started more than ever, is people were pumping this idea of true passive income. It's unless you're an LP on a syndication, you are not going to be a passive investor.
And we don't syndicate.
Exactly. And there can be people with limited roles in a joint venture, but being truly passive, the only way you're going to get that is having cash to place in a deal and be a silent investor. When you are getting started in real estate, it takes work. The only thing that's passive is how the income is qualified.
Now, there are exceptions to this because I've heard more than one person say this myth. However, I've noticed a lot of the people online who are going like, oh yeah, no, impossible. You can never cash flow a deal. Most of them are selling courses on wholesaling and flipping. Lo and behold, there are people buying single family, which is almost impossible to scale. There are people who are using little to no creative finance, so they can't negotiate their interest rate.
And you don't have to do creative finance. Our last deal on our next 3 deals are probably gonna be bank products. You can play the game with bank products, but man, do I wish we were doing seller finance in every single transaction.
They're a lot easier to close. They're more sure to close because your financing is already 100% approved. Like when you go under contract, there's an agreement for it. I'm a huge fan of seller financing, creative finance in general. But the principles that it takes to make a deal work. You need cash flow and long-term fixed rate debt. And as long with margin. And the thing that I always add in there is, yeah, you need to have a reserve fund. And if you don't have it, you need to find a deal where you can raise it. Do you know what that means? You have to say no to some deals that look pretty good.
Dude, we walked away from a deal that was going to put us really on the map, I would say, the 196 units in Waco, Texas.
That would have been, on a branding standpoint, would have been significant to move to Texas and immediately pick up about 200 units.
And we said no, and it was because of the renovation budget. We were walking that property, dude, the second one, because it was a 2-property portfolio. Oh. That second one, built in the 60s, those were some of the coolest unit layouts I have ever seen in my life. And we're walking this thing. We had the whole team with us. We had Danny, we had Corey, we had the whole team down there in Waco. And it was like, I'm usually the guy who's let's do it no matter what. It was, after some talking through things, it was no way, Jose, can we do this deal?
Yep. We saw a lot of galvanized steel piping, which on 200 units, you need a huge budget because all your plumbing is going to fail. You're going to have leaks everywhere, and it's massively expensive to do that many buildings.
Instead of raising an extra 2, we were going to have to raise an extra 3.5 to 4, I'd imagine, to be comfortable.
We would have had to do $1 million of trees on campus number 2.
Ridiculous.
Yeah, they're just massive overgrowth, and the...
And it looks cool.
Yeah, but you would have needed to bring cranes in to do some of the... It would have been...
And then insurance is going to be a nightmare on top of that.
Now, do you need 1,000 units to cash flow financial freedom? No, absolutely not.
Not even close.
I would say for the average person, though, you need to be looking 50 to 100 units in your portfolio. Yeah, unit count's not everything, but I'm just saying average is going to be in that range. So if you're thinking right now, in the next 3 years, I'm going to buy 10 units and I'm going to retire, I can almost guarantee you're not.
Unless you're buying in cash and it's a stellar deal like our 26 unit, then absolutely you're going to be able to, you're probably, if you're buying in cash, our 26 unit would probably be cash flowing realistically about $19,000 a month if I had no debt when it's stabilized.
Yeah, so if you already have $2 million, you can
but at that point you're already there, right? And it just comes down to the myth. I think this was really being pushed right at the start of COVID, kind of through that. Kind of when I was getting into the game more than anything. And it was like, you're going to retire, financial freedom, wholesaled forever, flip forever. It's like, are you going to build a business or are you going to build passive income?
If you, and someone just commented on my Facebook, again, I won't name drop them, but they're saying, oh, well, you need to listen to these guys because they have more money than you. Yeah, a lot of online influencers have more money than me. That's not uncommon. What I believe is true is you don't need to add steps. If your goal is to buy and hold, don't flip, don't wholesale. You should do 2 things. You should buy and then you should hold. Keep your business simple. It's going to be easier. Their argument was like, oh, well, buy and hold is like trying to learn calculus when you know algebra. There is nothing that you need to know in real estate beyond basic algebra.
Dude, I'm an absolute idiot and I can buy and hold. I'm going to be completely honest. And if we're talking about keeping it simple, titan of the game, a guy that I idolize, quite frankly, not in that sense, but Sam Zell. Titan of the game, bought his first triplex at 19 years old, eventually sold out to BlackRock. I think his portfolio was at $44 or $48 billion. He netted $6 billion off buy and hold. Now, he was doing office, and times have changed substantially since Sam sold and since passed. But
thank you for addressing that.
Yeah, the principles have stayed the business model's the same. You're buying stabilized assets, and he went in primo locations, but he held it all. He wasn't wholesaling it to somebody else. Granted, he eventually sold the REIT. But it's a different game. He held it, and that's where true wealth comes from. These guys who are making millions a year off courses and all that stuff, good for them. Good, they built a business. They're not holding real estate. And that's the difference.
It is. That is 100% the difference. Is buy and hold is a game where you will become very rich. And does it mean you're going to have less cash on hand? Absolutely. If you're just flipping properties and you're getting money and yes, the richest people on the planet hold real estate for long periods of time. You want the appreciation. And if you're someone who's like, hey, I'm willing to be patient and I can be frugal, if you can build a $20,000 a month passive income off of your rental properties and live off of that, first of all, that's more than a lot of people make.
Seriously.
But without scaling to the sports cars and the super house and the yachts if you can just play the game conservatively over a long period of time, and I'm talking 10, 15 years, I'm not talking a 40-year career, you can build insane wealth in real estate.
Absolutely.
Starting with no to low money down.
Absolutely. I mean, talk about mentor that's really helped me a lot. A guy named Andrew. Andrew, buy and hold real estate on big multifamily.
Mm-hmm.
The dude's not flashy. He lives in my apartment building, has very nice things, but he's not the guy who's out driving the Ferrari on the street. He's not doing this stuff. He's not selling courses. In that, he is truly wealthy. You look at some of these gurus and influencers who are out driving the Porsche and they're barely meeting their mortgage. I think a big thing online, it's you have the people who are just getting started. You have the people who are a little bit above that who you think have made it. And then there's almost this invisible wall of people who have really made it and are playing the game at the highest level that you don't see because they're not flashy. They're staying diligent on their craft, playing the game. And that's who you're missing.
We'll close with this. We built our entire business. Like I did this in Grant County. I did this in Mason County. Caleb's done this in Erath County.
It really looks like it should be Earth, but it's Erath.
We met the people who've done what we want to do. We actually met with the owners. A lot of these are older people who you wouldn't see online. And so when you're seeing these online influencers tell you like cash flow is a myth, we're out there with the investors that actually built passive income and built their financial. We're talking people $100,000 to $200,000 a month of passive income coming in every month. Is it 100% passive? Absolutely not. That's a tax designation. We can get into that in another video. But these are people who built their business, built their systems, and they bought on these principles. Some of them have been playing the game for 10 years. Some have been playing the game for 60 years. One of them, probably more than 60 years. He said getting deep into his 80s.
I think I know what you're talking about.
As you're playing this game, though, look at the people who've done the thing you want to do. And consistently across the board, what I have found is that the people who bought the cash flowing deals, who focused on buy and hold, who skipped flipping, who skipped wholesaling, they bought and held real estate. They are the people who are worth the most, who are the happiest, who have the most time. They spend the most time with their family, their children, their grandchildren. If that is what you are trying to build, I still absolutely believe that while it's not the flashiest and it's not the highest liquidity when you start out, the best strategy and the most tried and true strategy in real estate is buy and hold. And you can absolutely build your own cash flowing business doing that. And again, three things: you either more down payment, less interest, lower payments, and then always have a reserve. If you follow those rules, you will do just fine.
I'll close on this. I think the biggest thing out of those three for me, really speaking into what we've been working on lately, is having that reserve and how crucial that is. And I'm going to close on this. If the goal is flashy cars, a sports house, a mansion, that's cool. I just don't know if those goals are deep enough to get you to where you want to be. These guys who do it, a lot of these guys do it for views. They do it for clicks. And if the goal is true wealth in time freedom and what that looks like, you're not going to have the same path as these guys who are out driving the cars, who are sometimes renting the cars. I know you've done that as a joke in the past.
Yes, I have.
You're not going to look like that, and your time's going to be spent a lot differently.
Yeah.
And that's I think it's just coming down to who do you want to be, where do you want to get to, and that's going to define your next steps and who you're emulating.
So that's a wrap for today's episode. Look forward to more of this with Caleb, and we'll do more with Danny too on the channel. But very, very excited to have the new studio. Again, equipment is getting. We're getting there. Stuff. Yeah. Right now, you guys are sitting on my camera's microphone on one camera. This will be a multi-camera, multi-mic situation. These mics aren't even actually turned on. They're not plugged in.
We're looking like it though. If you made it to the end, appreciate that. You actually get to know the
If you watched all the way through, I would love to show you the rest of the studio and all the cool stuff they're talking about. Leave any of your questions in the comments. We're going to make videos on every single question. So if you have one, I will answer it either on Wakeboard Wednesday, or if it's a good enough question, we'll do a whole video on it.
Why not?
I appreciate you watching, but you only know if you subscribe. So subscribe, follow along for the journey, hit the like button because that helps us get out to more people, and we'll see you on the next episode.
Have a good one.